Good day, and welcome to the Senior Care Channel. My name is George Roach. I'm an elder law and estate planning attorney for over 35 years. Today's topic that we'll be talking about concerns long-term care. And how do we pay for it? How do we finance it? And what can we do to become eligible for government programs like Medicaid? To begin with, to simplify things, when you think about it, there's only two places in this world, really, you will ever need long-term care. All right? Where are you going to be? You're either going to be at home, living in the community, either independently or with somebody else, like a child or the child's family, as we age, or sometimes our medical condition, we become so sick that we need care in a nursing home. Those are the only two places really you're ever going to need long-term care, in the community or in a nursing home. Now, there are only two places you need the long-term care. The question becomes, how do we pay for it? How do we pay for long-term care in our society? When you think about it, there's only two places you need it, and there are really only three ways to pay for long-term care in our society. What are they? Well, number one is long-term care insurance. You may not have that. We'll talk about that topic briefly, but it's certainly a topic for another day as to what constitutes a good long-term care insurance policy. Sometimes people are a little too old and it's too expensive. So what are my other alternatives? Well, if you don't have long-term care insurance, the only other two ways you can pay for long-term care in our society are privately from your nest egg, what you saved up over the course of your lifetime, or number three, either through good planning or no planning. You will wind up spending every last dime that you have, and you become eligible for what we call taxpayer medical care, which we call Medicaid. Medicaid, not Medicare. Medicare is a topic we'll address on another day, but it's a shame that the words are so close together. I can't tell you how many times people say Medicare when they mean Medicaid, and Medicaid when they mean Medicare. So we're going to be talking about Medicaid, which ends in a D today. Taxpayer medical care. You must be poor enough, and I say put poor enough in quotes, because the strategies that we're going to talk about in this session will render you poor enough. The law, the Medicaid law, allows you to do these things here in the state of New York. Now, what you have to understand is the Medicaid is a joint federal and state program. The federal government sets the guidelines, but the various 50 states are given leeway to tweak their programs. And I can tell you that New York State is the most generous of all 50 states as far as things older people can do to protect their property. God forbid they need long-term care later on down the road. As I said, there are only three ways to finance long-term care. So, privately, what does long-term care cost? Now, let's take care in the community. Community, we call it care in the community because you're living in the community. You're living either independently in your own home or apartment, or you've decided because of whatever infirmities, you now have to go live with a child or somebody else, a brother or a sister. You're living in the household of another, but you're still in the community. You are not in a nursing home. And that becomes very important later on down the line when we will talk about the difference in the Medicaid rules. Okay? Now, I need care in the community. All right. Why would I need care in the community? Well, I've come down with dementia. I've suffered a partial stroke or a full stroke. Frail elderly women have fallen down, taken a fall, broken a hip. They can't get around. What can I no longer perform? Think about it. You can no longer perform what we call the activities of daily living. the activities of daily living. We call them in the elder law field the ADL skills. The ADL skills. What are they? They're the things we take for granted every day because we're healthy. We don't give them a thought. They are the ability to dress yourself, feed yourself, toilet yourself, wash yourself, bathing, mobility, what we call transference, the ability to get up and out of a chair, in and out of a car. You're healthy your whole life. You don't give these things a thought. We get dressed every day, take ourselves to the bathroom, we take a shower, we feed ourselves. But as we age, as we get old, as I said in previous sessions, nobody's got a crystal ball. You suffer a stroke, you come down with Alzheimer's disease, you fall and break a hip, any number of things where you can no longer perform, or it becomes very difficult to perform these ADL skills. Now, if you're living in the community and you're alone, living alone, who's going to help you with these activities of daily living? Or if you're living in the community with a child who goes out to work every day for 8 hours and maybe has an hour commute in each direction, you are home alone 6 to 10 hours a day or more. Think about it. Who's watching you? Who's feeding you? Who's getting you to the bathroom? Who's getting you up and out of a chair? If you cannot do these activities of daily living for yourself, you're going to need somebody to help you. Now, the people who help you with these activities of daily living, they are called home health aides, personal care aides, depending on the level of care you need. Home health aides, personal care aides. Who are they? They work for home health care agencies. Now, I've seen this. I can tell you, you do not realize what an important component of our long-term healthcare system these people are until you need them. Why? Very simply. If you can't stay home alone or in a household of another with a home health aide, where will you most likely wind up? In a nursing home. And my feeling is, and I'm sure it's yours, nobody wants to be there. Nobody wants to be in a nursing home. So people say, all right, by hook or by crook, get me a home health aide. Fine. What do you realize? Number one, these people are in short supply. All right? They're very, very important to you because they're going to allow you to remain at home. And everybody wants to be at home. There's no question about that. That's where you want to age, in your own home. So get me a home health aide. All right? What do they cost? How do I pay them? All right? And I'm going to give you some ballpark figures here. All right? If you need a home health aide here in New York, home health aides will cost you between $15 and $25 an hour. That's what you pay them out of your pocket. All right? This is the private pay from the nest egg. You pay them out of pocket. Now, how many hours a day do you need this person? Well, I live with my son. He goes out to work 8 hours a day. He has an hour commute in each direction. So when you think about it, you are home 6 to 10 hours a day or more alone. 6 to 10 hours a day. How many days a week do you need this person? Well, my son works 5 days a week. 6 if you want a day off. You know, I often say, you try being a caregiver for somebody with dementia and see how quick you get burned out. So you're going to need that home health aide 5 to 6 days a week. Maybe a day off, depending on what you can afford. All right? Now, what does that come to at the end of the month? Because when we do our budgets and we talk about Medicaid, we all budget on a monthly basis. And it's really not rocket science. You just multiply the numbers out and you will find on a monthly basis at those rates you are probably shelling out somewhere between $1,500 and $3,000 a month or more, depending on how much care you can afford and need. But that's the ballpark. $1,500 to $3,000 a month to pay for this home health aid privately. Now, obviously, if you don't have that kind of money or income lying around, that's expensive. Anytime you don't have that kind of money or income lying around, it's expensive. So the question becomes, how do I get Medicaid with a D, taxpayer medical care, to pick up the tab and pay my home health aid? That's the goal of this estate planning. If you do the proper planning and know what the rules of the game are, you can become eligible for Medicaid to pay for the home health aid. Now, the Jeopardy category is called Community Medicaid. All right? Why do we call it Community Medicaid? Because you are living in the community. You are not in a nursing home. Now, that's where the rules for these two types of Medicaid vary greatly. So we're talking about care in the community. We would like Medicaid to pay for it. Now, Medicaid is what they call an entitlement program. You become entitled to it by virtue of becoming poor enough. And I always say put poor enough in quotes. All right? So the question becomes, can I protect my nest egg and still become poor enough to qualify for community Medicaid? And the answer is yes. And to simplify things, I'm just giving you the basic rules here. There are 3 basic rules that you can follow for community Medicaid. Now, before we get into the rules, you must be considered, as I said, poor enough. When is an individual, and we're always applying for Medicaid as an individual, when is an individual poor enough to qualify for Medicaid here in the state of New York? Now, New York says you are considered poor enough when you only have 2 things left to your name. And here they are. Number 1, you are entitled to keep this year, for 2012. The amount will probably go up in 2013. It goes up every year. The amount you can keep this year is $14,250. $14,250 in what they call countable assets and resources. Money in the bank that you can have, $14,250. Now, in addition to that, the second thing you can have to be considered poor enough is what they call a prepaid funeral. You can prepay your funeral. And actually the money goes on deposit with the funeral director in what they call an irrevocable pre-needs burial account. You simply prepay the funeral. Those are the only 2 things you can have, $14,250 and a prepaid funeral, and you are considered poor enough to qualify for Medicaid, community Medicaid here in the state of New York. And by the way, that poor enough, those eligibility numbers, those 2 things that I just spoke about, they are the same whether you need community Medicaid or you need Medicaid for a nursing home. It's the same poor enough. Now, if we're applying for community Medicaid to pay for a home health aid, there are only 3 rules you have to remember. Now, most people that I speak to realize when it comes time for Medicaid, there is a 5-year look-back period on the transfer of assets. That's what most people think out there in the world. However, what they don't realize, what most people don't realize and most lawyers don't realize, is that 5-year look-back period that went into effect back in 2006 only applies to nursing home Medicaid. It does not apply to community Medicaid. There is no 5-year look-back period. There are no transfer rules. There are no prohibitions. Which means what? Which means if you need community Medicaid and there's no prohibitions on transferring assets, the rules of the game allow you to take your nest egg and give it away. You can transfer it out of your name. They cannot penalize you because you are only applying for community Medicaid. A nursing home would be a different story. So no 5-year look-back period. Well, who do I give my property to? Personally, I don't really care. You can give it to your spouse, you can give it to your kids, you can give it to an irrevocable trust, you can give it to the church. I'm not concerned with who you give it to. The rules of the game protect your nest egg. So you're permitted to transfer your nest egg out. They cannot penalize you for it. That's rule number 1. No transfer rules for community Medicaid. I don't know how many ways I can say that and emphasize that. Now, I said there were 3 rules. Rules number 2 and 3 for community Medicaid have to do with income. We took care of the assets, now we're dealing with the income. So, what comes in every month for most older people? Social Security check, and if you're lucky, a pension check. But certainly any interest income, dividend income, bond income, trust income, rental income, gambling income. Some of these guys get pretty good at that. All right? But for most older people that I see, Social Security and a pension. That's their income. Now, how does Medicaid treat income for community Medicaid purposes? Very simply. Medicaid says to you, look, we can't stop you from giving away your nest egg. There are no transfer rules. It is perfectly permissible. However, whatever your income is per month, Social Security and pension, and they add it up, IRA income, they add it all together, whatever it is, this year, 2012, and it more than likely again will go up next year in 2013, this year, Medicaid allows you to keep, magic number, $812 a month. That's what you get to keep here in New York to live on. Now, most people say, I can't live on $812 a month. And you're right. You cannot kennel a dog for $812 a month. Believe me, I've tried. But that's the amount you're allowed to keep. So what happens to the rest of your income? The balance of your income. The balance of your income, everything over and above $812, they call it your Medicaid overage, the amount you're over. Makes sense? Okay. What happens with that money? Now, I've had some experience in this field for over 30 years. What used to happen, because you got to realize by comparison, what used to happen was you kept the $812 a month, and Medicaid made you kick in the balance of your income. You had to pay it to the home care agency. It was your contribution. It was like a copay. You had no choice in the matter. You had to kick it in, and you were stuck living on $812 a month. Now, people said, wait a minute, I have expenses, living expenses. I have rent, I have a mortgage, I have taxes, I have utilities, I have groceries, telephone, cable. I can't give up that money. And Medicaid says, personally, we really don't care. You make the choice. And it was really a Hobson's choice that people were forced to make between their living expenses on the one hand and their medical needs on the other. Medicaid simply said, it's your choice. If you don't want to give up the overage money, then you're not getting Medicaid. And that was the case for many, many, many years. All right? The only time that situation really worked was when the senior citizen who needed Medicaid for home care was living with their children. Maybe mom was living in the basement. So she gave up the overage money, and her monthly rent was $812 a month to the kids. That was about it. Up until about 4 or 5 years ago, now we get that overage money back for you. We get it back so you can continue to live in the community, so you are not stuck living on $812 a month anymore. So that's the third rule. Rule number 1 for community Medicaid, just to recap, no transfer rules. Rule number 2, you keep $812 in income this year. And rule number 3, join a charity. Join a charity. Sounds like a nice thing to do. Is there a particular charity I should join? There are several. There's about a half a dozen charities out there you can join, but the charity that most people that I see seem to join is called NYSARC. Initials are NYSARC. .org, O-R-G if you want to look them up on the website. NYSARC. It stands for New York State Association for Retarded Children. Now, they've been around since 1949. They're a charity, and you do not have to be retarded to join NYSARC. As a matter of fact, when you go to their website, there are 2 documents that you can actually download and print out. One is the joinder agreement. Join the club. Join NYSARC. Is there a fee for joining NYSARC? Yes. The fee is $300, presently, $300. You fill out the joinder agreement, send it in. The second document that you can print out is a medical evaluation form, which you now take to mom's doctor, because mom needs the home health aid. You take it to mom's doctor, the doctor fills it out and essentially says mom is disabled and she needs a home health aid. It's almost a slam dunk, because if mom has a stroke, mom has dementia, mom fell down and broke a hip, she can no longer perform these activities of daily living. For older people, it's a disability. So once the joinder agreement and the medical evaluation form are in, you're now a member of NYSARC, the charity. And there are other charities. There are other charities out there run by UJA and a number of them, okay? Not just NYSARC. But at that point, what happens to the overage money? The amount of your income over and above $812. It doesn't go to the home care agency anymore. Like Medicaid used to force you to do that. Now, you take that overage money and you send it to NYSARC. You send it to the charity. All right? You're keeping $812 a month. The balance of your income gets sent to the charity. Now, what does NYSARC do with it? NYSARC takes that overage money that you sent them, and they put it in a special bank account for you. That bank account has a special name. It is called a pooled income trust. A pooled income trust. That's the bank account that NYSARC runs. He puts your money in there. All NYSARC is doing is they're simply pooling everybody's money that's a member. They put it in there. Now, once your money is on deposit with NYSARC in their pooled income trust, what do? You simply sit yourself down at the table and you make out a list. A list of what? You make out a list of your fixed monthly expenses. Your fixed monthly expenses. Whatever it costs you per month to live on. All right? You list your mortgage, your taxes, your electric, your utilities, your rent, cable, television, groceries, telephone, you name it. Matter of fact, one of the things we start telling older people to do is start buying your groceries on your credit card, because now you have a receipt that you can send to NYSARC. So you send all your bills for your fixed monthly expenses, you send them up to NYSARC. NYSARC gets them. What do they do when they get your bills? They simply pull out their checkbook, open it up, and they pay your bills. They pay your phone bill, they pay your LIPA bill, they pay your grocery bill. All right? So think about it. You get back that overage money to live on. You don't have to give it up anymore. You get it back to live on. Nobody's got to be stuck living on $812 a month anymore. Right? NYSARC will pay those bills for you. So think about this. When you think about it, Medicaid, the Medicaid system, does not trust you enough to pay your own bills. However, if you use a charity like NYSARC, they will let NYSARC pay your bills. All right? So when you think about it, all NYSARC becomes is a third-party payor of your bills. You're just giving the money to a third party, and you're letting them pay your bills, and Medicaid will pay for the home health aid. So you're getting back that extra income to live on. Nobody out there in the audience, if they need community Medicaid, should ever wind up living on $812 a month anymore. That's community Medicaid in a nutshell. All right, those three little rules. Now, let's talk about nursing home Medicaid. God forbid you get sick enough where you do need a nursing home. You can't stay in the community anymore. So the question becomes, all right, if I need a nursing home, how do I pay for it? Same three ways we talked about in the beginning. Long-term care insurance, but if you don't have that, then you're either paying for that nursing home privately, or through good planning or no planning, you become poor enough to qualify for Medicaid, and Medicaid will pay the nursing home. Now, if you don't have long-term care insurance, you're stuck with private pay and Medicaid. So let's talk about private pay. I'm glad you're all sitting down. What is the cost of being in a nursing home here in New York, on Long Island? Now, regionally, all right, the cost of being in a nursing home here on Long Island runs average. And you can underline the word average. Average meaning some are more expensive, some are less expensive. The average cost of being in a nursing home is approximately $350 to $400 a day or more. $350 to $400 a day or more. Now, this is not rocket science. How many days in a year? 365. 366 if it's a leap year. But 365. If you had a handheld calculator, or you have one of those math brains, you simply take 350 a day, the low end of the scale, times it by 365, and it will give you $127,750 a year. 127,750 a year. Think about your nest egg. All right? Divide that number by 12. Nursing homes privately, ballpark, will cost you between $12,000 and $15,000 per year. Per year. Think about your nest egg. Think about what you have saved up. How long is it going to last when you're spending money at $15,000 a month? You're going to get Medicaid eligible real quick at those rates unless you do something. So, what can I do to become Medicaid eligible if I need a nursing home? Now, here's the answer. The easiest way to become Medicaid eligible if you need a nursing home is to be married, is to have a spouse. I often say it's cheaper to keep her, or him as the case may be. Why? Very simply. When you're applying for nursing home Medicaid, most people know there's that 5-year look-back period. All right? Medicaid, think about this. When you file an application for Medicaid, you are saying to the Social Services Department, I am poor enough. The person applying, the applicant, I am poor enough. The only two things I can have to my name are $14,250 and a prepaid funeral. Now, as we said, for community Medicaid, they can't penalize me for giving away my nest egg, but they certainly can if I need a nursing home. That's where the 5-year look-back period comes in. The Social Services Department, Medicaid, is entitled to go back 5 years into your financial past, looking to see how you became poor enough. And essentially, it's a forensic audit of your finances. They want to see 5 years worth of bank account statements, checking account statements, deeds to houses, IRAs, any assets you have in your name, they want to see. And you have an obligation to provide them with it. You cannot materially misrepresent or conceal assets from the Medicaid department. Now, are there exceptions to that 5-year rule? Yes. One of the big exceptions is a spouse. Whenever I have a spouse situation, husband and wife, there's only 2 rules you got to remember. And here they are. Rule number 1, there is no 5-year waiting period on the transfer of assets between spouses. As a matter of fact, transfers of assets between spouses are exempt transfers under the Medicaid law. They cannot penalize you for transferring assets to. The second rule the Medicaid law gives her what we call the right of spousal refusal. All right, the right of spousal refusal, which is the right to keep that property and say, no, it's not available to pay his nursing home bill. I need it to live on. As a matter of fact, all the spousal refusal thing is, in a nutshell, it's a form letter. We in the elder law field call it the spousal refusal form letter. The wife signs it. It goes in with the husband's Medicaid application, and it says to the Social Services Department, sorry, I'm keeping the property. Now, this is where individual counties differ. There are wrinkles here. For example, if you live in Suffolk County on Long Island, once they get the spousal refusal letter, end of the case, husband gets the Medicaid. However, if you live in Nassau County, the 5 boroughs of the city of New York, or any of the upstate counties, Westchester, what happens is you get a letter from the county attorney's office or the city council's office saying, we want some of that property you're keeping. We want a contribution. So you just have the added headache of entering into a negotiation with the county attorney's office as to how much property you can keep. But in Suffolk County, out on Long Island, once the spousal refusal letter goes in, you're good to go. The husband gets the Medicaid, the wife keeps the property. Now, most people would say maybe that's the end of the story. We're talking about planning here. Husband will get the Medicaid, he's poor enough, the wife has the property. She visits him in the nursing home 3 times a week until one day she comes down the driveway and bang, she gets hit by a milk truck. She predeceases him. As I always say, nobody's got a crystal ball. We assume the person in the nursing home may pass away first, but it's not necessarily so. So what happens if the wife, the healthy spouse, predeceases her husband in the nursing home? Okay, the kids go and they get mom's will, and what does mom's will say? Lo and behold, everything I own to my husband, who's alive and well in the nursing home, and he may not even know it. So back goes all this property to the husband. He's knocked off Medicaid, and you wind up spending that property at $15,000 a month. And all this planning went out the window because the wrong spouse died first. So there's a second part to this planning with spouses. Once the husband is on Medicaid in the nursing home, that community spouse, the wife, in our example, it is incumbent upon her to start doing some planning and put those assets beyond their reach, maybe using an irrevocable trust as a planning device. And we run the 5-year period, the 5-year waiting period, as to her while she's healthy. Spouses, pretty simple, straightforward. Now, what happens if you don't have a spouse? If you don't have a spouse, don't run out and get married. The cure is worse than the disease. Don't do that. Out of the frying pan into the fire. All right? If you don't have a spouse, widows, widowers, single people, and divorced people. All right? A lot of those people out there. No spouse, you are the people that are stuck with the 5-year look-back period. So what are your options? You can certainly give the property away and hope you make the 5-year period. And sometimes that's a gamble. Obviously, if you're 70 or 75 years of age and in fairly good health, you can sit on the sidelines for 5 years. You can wait out, all right, the period. But as we age, it's a fact of life. If you're in your late 80s, early 90s, and now you want to start giving this property away because you fear you might go into a nursing home, you have a 5-year waiting period. What are your chances of waiting out the 5 years when you're in your late 80s or early 90s? Sometimes you've simply waited too long. And as I always say, you should have got to the table sooner. You should have did this planning sooner. So you can give it away, or you can probably use the gold standard for nursing home planning and Medicaid is what we call the irrevocable trust. All right? And all a trust is, as a concept, it's a box. It's a lockbox. You create a lockbox with an irrevocable trust. And in that box, you put assets, your assets, in order to protect them. What do you put in the box? Whatever you like. Most of the time, the house goes in the box. All right? But you can certainly put money in the box. You can put stock in the box. Any income-producing property that you put in the box, you will get the income from that property, just like you did when it wasn't in the box. Right? Any assets you put in the box, you simply have a 5-year waiting period, all right, for the assets in the box. Once the 5 years is up, those assets in the box are protected, all right? And not only are they protected for Medicaid purposes, but even if you pass away, that irrevocable trust passes those properties just like your will would. So the whole focus, as I say, of good estate planning is to avoid probate. You can have your cake and eat it too by using an irrevocable trust. It really is the gold standard as far as Medicaid, nursing home, and estate planning goes. They're very flexible documents. Now, who holds the key to the box? You choose the people who hold the key. Many times it's a child that you might trust, or two children. It's very flexible in that regard. It may not be the children. It may be somebody else. Certainly the children are the beneficiaries of that trust. All right? And the trust is flexible in that the trustees have to follow your directions. You write the rules, or the attorney who drafts the trust writes the rules, and those are the rules that have to be followed. If they decide for some reason they don't want to follow the rules, you can essentially change the beneficiaries of the trust. All right? We call it a thing called the hammer. All right? If you lower the hammer and you change the beneficiaries, you can cut those kids out if they don't follow your wishes. All right? So you have that control. All right? Lastly, what if you don't want to give up that control? All right? Talk a little bit about long-term care insurance. All right? Long-term care insurance, and I've been in this field for over 35 years. What have I learned? All right? I see what Medicaid does to people. I've just given you some of the basic rules. It's an involved process. It's very detailed when it comes down to each client. All right? But I see what Medicaid does to people and how it forces them to spend assets and spend income. And I said to myself, not going to happen to me. So what I did was I went out and got a good long-term care insurance policy. I insured myself against this risk. And basically, and we could talk about it in another session in more detail, there are only 3 things you need in a good long-term care insurance policy, and I have them. All right? The average cost per day was $350. Policy's got to pay at least $350 a day. All right? Suppose you're a little frugal and you purchase a policy that only covers $250 a day because it's a cheaper premium. Absolutely true. All right? If you have one for $250 a day and you go into a nursing home, how much are you short? Now, rocket science, $100 a day. Okay, if I'm short $100 a day, how many days in a year? 365. Just add the zeros. You buy one for $250 a day and go into a nursing home, that policy is now costing you $36,500 a year coming out of your pocket. So don't buy one for $250. What do the Rolling Stones say? Get what you need, $350 a day. Requirement number 1. Requirement number 2, you do not have a spouse. What is the look-back period on the transfer of assets for Medicaid for a nursing home? 5 years. All right? Is there any way I can reduce that? There is. Requirement number 2 is you go out and purchase what they call the New York State Partnership Policy. New York State Partnership Policy. Matter of fact, they have a website, and the website is NYSP, as in Peter, LTC, NYSPLTC.org. That's their website. Now, the partnership policy, the deal with the partnership policy is it only has a 3-year term. It only covers you for 3 years in the nursing home, which means if I have a partnership policy and I go into a nursing home, That policy will pay the nursing home for 3 years. Now, what happens at the end of 3 years? We call this the big if. The big if is, at the end of 3 years, if you are still alive, at the end of 3 years, the state of New York guarantees that you will be eligible for Medicaid. You have to apply for it, but they'll put you on the Medicaid program in the nursing home because you had a partnership policy. So you don't have to wait the other 2 years on the transfer of assets. And by the way, you can go on Medicaid in a nursing home with a partnership policy after the 3 years are up, whether you've given away your property or not. The problem is the average stay in a nursing home, because people are very sick, is less than 3 years. So if you survive the 3-year term of the partnership policy, you're automatically on Medicaid, your property is protected. And the last requirement, number 3, for the long-term care insurance, is what they call a 5% inflation rider. 5% inflation rider. What's that? The inflation rider is a bell and whistle. You pay for it, but it allows the pool of money to grow. Think about this for a second, conceptually. When you buy long-term care insurance, what are you buying? You're buying a chunk of money that hopefully you will never need. What does Kenny Rogers say in that song, The Gambler? The best that we can hope for is to die in our sleep and the gambler faded away. The insurance company says to you, you don't need this money now, do you? Heck, I hope I never need it. I don't want to wind up in a nursing home. But insurance, no matter what kind of insurance we're talking about, car insurance, fire insurance, long-term care insurance, life insurance, insurance is like a parachute. It's better to have it and not need it than to need it and not have it. So if you can afford that long-term care insurance policy, get it. How much money? Well, I bought $350 a day times 365 days times 3 years. That's the term. You do that math, it comes to a little over $383,000 that you just purchased. That's your chunk of money. The insurance company invests that money for you at 5% a year, so that pool of money, every year you stay out of the nursing home that you're healthy, that pool of money grows by 5% and gets compounded. So down the road, 10, 20 years down the road, you could have over $1 million sitting in that pool, all right, to pay for the cost of that long-term care in the nursing home. So it's certainly an option to look at if you can afford it, all right? But that's my little take. We'll talk about long-term care insurance probably in another episode, another session. But for today, that's basically Medicaid and how we finance long-term care. I wish you all the best. Thank you.